Welcome, everyone. It's Angelo Robles to the Angelo Robles podcast. I'm also the founder at Family Office TV and SFO Continuity. And yes, as many of you know, I'm also the founder, of course. The founder status doesn't go away. Many years ago, a family office association, I transitioned in selling my interest in FOA a couple of months ago. So I'm no longer the chairman or active in any way, but I'm still proud to note my heritage for over 15 years as founding and running and being active in an organization like FOA. But I'm really excited about the future and what I'm doing in the family office world as I hope somewhat of a figurehead and thought leader, and the work that I'm doing at Family Office TV, which is where many of you will actually probably see this video, although I may put it on my @Family Office channel as well. But on that note, I'm really excited about today. It's the first time in several months that I've had an economic and macro discussion. The last time, as many of you would remember, was with the one and only Mark Faber. It was very late at night his time, and we were enjoying some Woodford Reserve and a cigar. That was an interesting interview. Today, we're going to discuss investing when the world is in chaos. Now, when is the world not in chaos? So, of course, that's a little bit of you got to give me a clickbaity title here and there. We have a very special guest. He's very popular. He was on once before, really enjoyed it, although it's been over a year. Our special guest is Jared Dillian. He's the founder of Daily Dirt Nap, one of the greatest names for a financial macro newsletter, of course, of all time. Jared is an economic and macro pundit for professional investors, and he's the author of multiple books: Street Freak, All the Evil of This World, Those Bastards. Am I allowed to say that on YouTube? I think I am. So let's go with it. Those Bastards, 69 essays on life, creativity, and meaning. In case you're wondering, why am I looking so hard at my notes? Of course, I printed that out, and that printed in a lighter font that is incredibly hard to see. And at my age, it's not so easy. But more importantly, Jared's latest book, I could see very clearly. No Worries: How to Live a Stress-Free Financial Life. Jared, I don't know. Sometimes the more money you have, it seems like the more stresses I have and things to worry about. Everyone, let's welcome Jared to the show. Jared, how are you?
Doing great. Thanks for having me.
I mean, being a little comical, I think, for a second, but I think there's a degree of truth to it. Actually, the more you have, often don't you have more to worry about? So is that really stress-free?
Absolutely. But you can... The source of all financial stress comes down to two things. It comes down to debt and risk. So it literally, if you structure your affairs in such a way that you have minimized debt, or you don't have any debt, or you've minimized your risk in the capital markets, then you've effectively minimized your financial stress. So it's absolutely true. You know, there are people who don't have any money and they're perfectly happy because, as you said, when you get more money, things get complicated and there's a lot more to worry about. But you can set up your life in such a way that you don't have to even think about money.
Yeah, I mean, I guess as Big E said, right? More money, more problems. But yeah, I mean, if we look at Maslow's hierarchy, the reality is that money is impactful for housing, for food, for education, for a variety of things. To ignore that and to kind of poo-poo that and glance over it is kind of just foolish and ridiculous. On the other side, like I said, and I've been dealing with billionaires basically most of the last 15 or 20 years, they do feel, I guess you could say, a sense of obligation, a pressure of not knowing who to trust, and a fear, especially if they come from nothing, of like, they tell me in the interviews, they literally to this day, so many of them have nightmares about like how it used to be and what could happen. And, then they tell me, well, I got the confidence and the network and the know-how now, I could do it again, but there's a little bit of fear in their eyes. So you just never know.
Yeah.
Let's get to it. So inflation is down overall from last year. However, it's still above the Fed's target. Really, the key question is, do you think the Fed will continue to pause, to cut, or to raise rates moving forward?
Well, first of all, inflation is lower than you think. Like if you look at private real-time measures of inflation, like the Trueflation data, if you go to trueflation.com, you'll see that our inflation right now is about 2.4%. So we're getting close to the target. Um, the last CPI print was about 4%. I think it was 4% exactly, but we're going to get down into the threes, into the twos over the next 6 months. And then there's going to be a decision for the Fed what to do. Now, one of the things about the Fed is that if you remember 3 or 4 years ago, we had CPI at 1.7%, and we were doing quantitative easing, printing trillions of dollars just to get inflation up to 2%, and deflation was the fear. So one of the things I think about is if they were willing to take those extraordinary monetary policy measures just to get inflation up to 2%, what are they going to do to get it down to 2%? Because we're getting pretty close, and I think most rational people, like if you had some rational people at the Fed, they would say, okay, CPI has gone from 9.1 to 4. Why don't we take a break for a year and just let this pass through the economy? But they're not doing that. We have 2 rate hikes scheduled before the end of the year. If you look at the Fed funds curve, the market thinks that we're not going to do those rate hikes. We're actually going to have rate cuts. Saw some pretty terrible PMIs today in Europe. So, the next big piece of data is going to be the payroll number in July. Yes. And as you know, we've had 14 months in a row where payrolls have beat estimates. If payrolls don't beat estimates, you're probably going to see 10-year interest rates drop 0.25% in a day.
Wow. If I can wave a magic wand and I can make you the Fed chairman, what would you do?
Well, I would pause here. Okay. I would not plan for more rate hikes by the end of the year. That's for sure.
Well, the market, of course, is going to like that. And that leads me into my next question. I know this is relatively basic for family offices and hardcore investors, but again, I have more and more people to my channels that are younger in high school and college with some of the speeches that I do. And you think if they're in economics, they would know, but maybe give us a 1-minute economics lesson about why this matters, whether we pause now, whether we raise interest rates or lower interest rates, the impact broadly on the economy, and maybe more specifically, the stock market.
Well, the 10-year interest rate is probably the most important price in the financial markets. If you are a 10-year trader at a bank, you are one of the most important people in the world. You are setting the most important price in financial markets. Has to do with expectations of future economic activity, has to do with expectations of inflation or deflation. It's the most important thing. Now, right now, our yield curve is extremely inverted. We have 2s up above 5%, and we have 10s around 3.7%. It's about 130 basis points inverted. And basically what the bond market is saying is that we don't believe the Fed. We don't believe that they can sustain that level of interest rates over time, that the economy is going to weaken and it will require lower interest rates in the future. All bonds essentially are the future path of short-term interest rates, right? It's true of 2-year notes, but it's also true of 10-year notes. So, I think we will have some sort of recession. I don't know what it'll look like. I don't think it'll be as severe as perhaps other recessions in the past, but economic activity is slowing down. It will continue to slow down, and I think interest rates will decline.
Yeah, we're going to talk a little bit about population, GDP, and that overall impact coming up relatively shortly. So again, keeping it relatively basic for now, you think and likely they're going to pause. They may raise a little bit, but we could argue they may lower a little bit too. If so, how should investors proceed? And I know this means being tactical and not necessarily looking at it as set it and forget it. But again, a lot of our investors are very sophisticated. So from the perspective of if it plays out like you think it will, what impact will that have on the stock market?
Well, first of all, one thing I want to point out is that a lot of people do, if your investors have some allocation to equities, and I don't know what that is, it's probably not 60 or 70%, it's probably lower. But if you have an allocation to equities and you're dollar cost averaging, you have to send in those checks every month. You have to do it in good times and bad times. And what a lot of people did in 2022 was they got scared during the bear market and they stopped contributing to their investments, to their equity allocations. And now that the market is up 20% off the lows, they're contributing again. And you can see the flows. I mean, you can see the flows into the equity markets. I don't really have a strong opinion about stocks here. I can tell you that if we do get a weak payroll number, I think it'll be good for stocks in the short term. I also think that, a lot of people look at this very linearly and they say, well, we're going to have a recession, therefore the stock market is going to go down. Well, the stock market already did go down in 2022. That was the stock market discounting the recession that we're going to have this year or next year. So I don't think it's necessarily the case that we have a recession and we get another bear market. I don't think that's necessarily the case. So I think it's important to maintain that allocation to equities.
And let's talk a little bit about gold. So I looked up some of the numbers just a couple of minutes before, so pardon if they weren't in the best sources, but I believe so far, year to date, gold is up 4.76%. The central banks appear to be doing a lot of buying. What direction, partially depending on how you think the Fed will act, but more global macro pictures as well, for the remainder of this year, what's your outlook for gold?
Well, gold topped about 3 months ago at about 2060, which was a triple top in the price of gold. And if you're a technician, there's no such things as triple tops. And the correction since then has been pretty shallow. The gold is off about 5 or 6% from the all-time highs. The price action has been pretty terrible, but in the context of a correction, that's actually a very shallow correction. And what I've noticed about gold is that it responds very positively to dovish economic data. So even today with these PMI numbers, gold is up over 1%. Just on this weak data. Anytime we get a piece of weak data, gold is up about 1%. So if you look at gold and it's shown this relative strength and it's only declined about 5 or 6%, and then the Fed actually decisively pauses interest rate hikes, I think you're going to see new all-time highs in gold. We're not that far off. So,
wow. Although people look at me as being active in the world of Bitcoin and crypto, I've always been a fan broadly of gold. I tend to be a little bit of a disaster, kind of what could go wrong kind of guy. And yet I have been scratching my head. It's been a little different maybe the last year or so, but it seems like gold is, I hate to sound nefarious, but I almost wonder if it's like artificially suppressed. It seems like there have been periods where it should, by theory, be more than it actually is, but it's not. I don't know if you have an opinion about that.
Yeah, I'm not a gold truther. I don't think there's manipulation, but I do think that there are a lot of fund managers who like to short gold. First of all, gold is easy to short. There's no carrying costs, basically.
Yeah, true.
I think that it tends to be a popular short. And when it starts trending lower, the old timers know when gold trends. And in that move from 2000 to 1600 last year, that was a really big trend. And that was a popular trade among macro hedge funds to short gold. And it worked until it didn't.
That is true. Going a little round robin from an investing perspective, year to date, the S&P, and again, my numbers could be a little off, pretty damn good, 16.2%. I think we kind of covered it with a little bit of how the economy has played out and interest rates so far this year. but any specific comment from the horrific year for like practically everything that was 2022. So we're just about now halfway through 2023. Broadly, things look better, including the S&P. Any specific comment relative to the growth of stocks? And has that been driven by a small number?
Yeah, I mean, you hit on it. There's basically 7 stocks driving the performance of the S&P this year, which is the lowest breadth in the recorded history of the stock market. And it's been a very bad year for active managers because unless you own Facebook or Meta, excuse me, Tesla, Nvidia, Microsoft,
Yeah.
Unless you own one of those 7 names or all of those 7 names, you've just been left in the dust. I was talking to a money manager yesterday at lunch, and he's like, it's been a terrible year for me. The S&P's up 15% and I'm flat because I'm buying energy, I'm buying basic materials, I'm buying value, and this stuff hasn't moved at all. So, when I look at the stock market, I look at the index, and I'm a bit of a technician and I'm pretty good at charting the index. But if you don't own the index, if you own something different, then you're not going to achieve those returns.
Very true. And we'll get to some of that upcoming shortly, but going a little bit round robin on this year. Well, I guess they don't work in lockstep because although gold is up, not bad, silver is down, what, about 8%? Why?
Oh, I have no idea.
Yeah, silver's always been an interesting one. It's another market that I think could be subject to nefarious influences. Why don't I put it that way? Let's talk about, and it'll probably be our only subject relative to crypto for about 10 seconds, but Bitcoin. Bitcoin actually is having, I guess you could call it a pretty great year. What is it up so far? About 81%. I think as we've learned, nothing is always, that's the key word, an inflation hedge. There have been times when it was gold, when it was real estate, when it was even the dollar, but it seems like that varies. Yet people, so going back a little bit to Bitcoin, what do you think is behind that? And do you think that will continue? And does that go lockstep relative to the economy and interest rates as well?
Well, most recently, you probably saw that BlackRock filed for a spot Bitcoin ETF.
Mm-hmm.
And based on what I've seen online, that's probably going to get approved. They probably wouldn't have filed for it unless it was going to get approved.
It is BlackRock after all.
Yeah.
Yes.
So that's been responsible for this move from 25,000 to 30,000 in Bitcoin. I got to tell you, like, Bitcoin's done pretty well, but it's been a pretty bad year for the rest of crypto.
Sure.
It's been marginally okay for Ethereum, but as you go down in quality among the altcoins, it's been really terrible. So, a lot of people look at Bitcoin and they say, oh, well, crypto is coming back. I mean, that's absolutely not the case. A lot of this stuff is still down 90, 95%, 99% from the highs.
That is true. There are some people that are very, very talented in trading from, let's broadly call it the shit coins. And that's a very, very risky business. But there are some that do make a tremendous amount of money doing that and playing on those different changes that are occurring almost by the minute, but certainly daily. And oil, interesting. It is down, I think, ballpark about 6.8% year to date. What is it now? About 71, 72 a barrel. How do you think that will play out through the end of the year?
When oil peaked last year, I pretty much called the top in oil based on sentiment. I said that people were overly bullish on oil. And as much as people were overly bullish on oil, I think we've almost reached the opposite extreme in sentiment this year. You've seen a lot of prominent oil bulls who are pretty close to capitulation after this bear market in oil. So, I watch the price action pretty carefully. I mean, it's terrible, but if I were to put on a trade and hold it and not look at it for the next 2 years, I would probably buy energy and short tech.
That is an interesting strategy. Thank you for sharing that with the audience. Okay, let me get into the next one a little bit. I'm based in Greenwich, Connecticut. We all know the so-called hedge fund capital of the world, and I've interviewed at Family Office Association events, more commonly from Ray Dalio to many others. Once hedge funds reach a certain size, they really become more money-making machines, asset gathering, quote unquote, the 2 and 20 model, or sometimes more for the hedge fund PM. They're entrepreneurs and good for them. No issue with that whatsoever. I totally believe in capitalism. But at that stage, they're placating the institutional investors. They're playing it safe. They're more spread out because that is the way to hedge your risk more to a degree. What I'm getting to is when a hedge fund is at its earliest stages, and even great investors, do you still believe in kind of power law theory that really you got to make more concentrated bets, arguably sometimes with leverage? And if you're able to get the right tailwind, the right decision, you could argue a little bit of luck. I mean, that could make a great investor take off. That could make a family office. That could make a great hedge fund. How important is being concentrated in the right choice and, quote unquote, Peter Thiel's power law and all that?
What you basically described was Paul Tudor Jones in the 80s. I mean, that was basically how he ran money back then, very concentrated bets with a lot of leverage. And Stan Druckenmiller has talked about diversification and about how diversification is the enemy of, supernormal returns. So, he calls it diversification. So I think if you have a small hedge fund, 100 million, 200 million, even 500 million, like, to take those outsized bets with leverage is entirely appropriate. Your investor base is different than it is with Bridgewater,
Right. Who's gigantic institutions that want to get 5 or 6% a year, basically. Yeah, it's a totally different market. A little bit related to that subject, when I mentioned tailwinds and all that, are we nearing the end of a tailwind of effectively declining interest rates, which really for the last 20 or 30 years, I mean, don't confuse brains with a bull market. We've had an amazing run. When you look at everything in the US, to some degree globally, with GDP, with interest rates, everything was impactful over a multi-decade period broadly of great success. Is that coming to an end?
Well, Jim Grant is out there basically calling for the biggest bond bear market of all time, just saying we're going to have years of higher interest rates. And that may be true, but I think what I want to point out is, you said, we had a 40-year period of declining interest rates. That was a 40-year period. That's a really, really long time. And interest rates may go up, but they may go up over a 40-year period, which is a really, really long time. So, when I'm saying that interest rates are going to decline in the short term, I think it's entirely possible, but we are in a higher interest rate regime that is going to last for a couple of decades at least. We are not getting back to 0%, 1% interest rates.
Let's talk a little bit about maybe the fallacy of more information. Does more information help us make a better decision from our conversation today, more on the investing front? I could argue, and I know in VC, there's been empirical studies, the more data points beyond a certain point that a VC has on an entrepreneur, the less likely, I know it sounds counterintuitive, the less likely they are to be successful. Therefore, should we limit the amount of inputs that we get? And you did mention the 10-year being one key input for you. So the big question is, what key information should we be looking at? And maybe what is your top 3?
Well, it depends. I mean, I totally agree that more information isn't necessarily good. And I can tell you that when I write my newsletter, I actually cut off sources of information. I don't watch TV. I don't watch CNBC. I don't watch Fox Business. I don't watch Bloomberg. I don't listen to the radio. I don't look at YouTube. Basically, my only sensory inputs are what I have on my Bloomberg terminal and Twitter. And that's the only inputs I use. So I think less information is actually much, much better, because all investments can be boiled down into an idea. And a lot of people have talked about this. Peter Lynch has talked about this. But the idea that if you can't explain this idea with a crayon, then it's not a good idea. Like, everything has to be very, very simple. It's one of the things I try to do in my newsletter. I try to keep ideas very, very simple.
I agree with that. What you mentioned the 10-year. Is there any one other index, copper divided by gold or whatever is applicable to you? I know I threw out what Jeff Gundlach and Adam Robinson won, but if you got others, let us know what they are.
Well, I look at technical indicators, and when I'm looking at charts, I look at a combination of the DeMark indicators and MACD, moving average convergence divergence. And when I look at those, if they line up, then you usually have a pretty high probability signal. So that's what I look at when I look at charts. I don't really look at like copper divided by gold or anything like that. I don't look at economic indicators like that. I'm usually looking at technical stuff.
And I have about 100 more questions, but I did promise the audience that I would be more interactive with our live audience today, and I'm promising to try to be better at that. I'm gonna slightly tweak 2 questions being asked in the chat. Does the man, the government, the system, the powers that be want a decrease in population that could be significant?
That's an interesting question. I don't know if they want it, but we're going to get it. I mean, birth rates are just absolutely plummeting. You're going to see global population peak within the next 10 or 15 years, and then it's going down. And we're seeing population declines in Japan and Russia and elsewhere. We have immigration in the US, so it's happening more slowly. But the whole profession of economics is based on an environment where populations are going up. And when populations are going down, everything runs in reverse, and you have to throw out the whole playbook. So we are totally unprepared to deal with investing in an environment where populations are actually declining.
And we are going to talk about that, the young man who asked the question, in a little different perspective in about 10, 15 minutes. Very random, but someone does ask, I know they've made a good amount of money being concentrated in this sector going back a decade or longer ago. But why, this is very specific here, Jared, why do energy drink stocks continue to perform? Look at Monster, look at Celsius. Now, maybe this person's a workout fanatic and freak and likes to be caffeinated and is wired 24/7, I don't know. But any specific feelings about that, if I could call it a sector?
It's funny. I have always wondered that. I don't have the answer to that. I have no idea. I don't know why.
Could be the subject of a next book.
Yeah.
Energy drinks and why they do so well. Let's talk a little bit about one of my favorite subjects, the almighty dollar. So the Dixie is down a little bit, year to date, probably about 0.6%, give or take a little bit. The euro, to give an example, is actually up a little bit by ballpark, I believe, 2%. This may go back to a little bit of our earlier discussion on the economy, GDP, interest rates. So last year, the dollar did great. What is your opinion relative to why the dollar is down a little bit this year?
Probably anticipation of a recession, but also I want to point out that sentiment around the dollar got really, really hot last year. We both know of some people on Twitter who have this dollar bullish thesis. They call it the dollar milkshake. It turned into a little bit of a cult. It's a little bit of a doomsday cult, because if the dollar is rallying, usually all other assets are declining. and it got very, very popular and peaked as of last year. And I think sentiment is going to totally go the other way. I'm very bearish on the dollar at the moment. And if we see the economic data continue to weaken over the next couple of months, I think the dollar is probably going to go down another 3 or 5%.
Wow. We are going to come back to that from a little different perspective in a couple of more minutes, but I wanted to throw that out there. But I guess I will comment for now. I mean, the dollar's demise has been called on what feels like forever. If you go by certain cycles, we do appear to be at the end of a cycle that really started, I guess you could say, after World War II. However, it's always a little bit more complicated than that. One, what would take its place? And that's some of the things that we're going to get to a little bit further out. But one day, a broken clock is right twice a day. One day that call will be correct. The dollar won't be, quote unquote, the almighty. In the short term, and maybe this is for the billionaire crowd. Sorry, everyone else. Should they be diversifying away from the dollar in small amounts, even if it's a currency play? Off the top of my head, maybe the Singapore dollar, in Norway, the krona, and of course you have the Swiss franc. What do you think?
Yeah, I think that's not a terrible idea. I mean, if you look at a chart of purchasing power parity of the dollar, basically the real value of the dollar, it's pretty much at all-time highs. The dollar, on a fundamental basis, the dollar is overvalued and has been for a few years. So, yeah, I mean, I think it's entirely reasonable to diversify into other, what I would call hard currencies.
And let's talk, a little bit. Broadly, inflation from 2000 to 2022, I think some of the numbers were gold price about 8.4% a year. Money supply growth, that's an interesting one, almost 7%. I'll give a couple of more. Oil about 4.7. Median house pricing, we're going to get to that one, 4.6. CPI only 2.6, but for many years we had so-called very, very low, quote unquote, by CPI. The one I want to focus on a little bit, but you're free to comment broadly on that and other assets inflationary wise impacted by that. I'd like to talk a little bit about real estate, homes. So right now we have mortgage rates that are maybe by normal standards over 50, 60 years, not half bad, but by what we were used to, due to declining interest rates, they're wickedly high at about 7%. Do you think we're in for a prolonged bear market in single family homes? And given COVID and all that, is all this going to be impactful to commercial real estate and refinances as well?
Well, I have a strong opinion about residential real estate. I think it's going to hold up just fine. What you're seeing is a phenomenon right now. You saw a lot of people on Twitter who are predicting a housing crash on the basis of mortgage rates going up. And they were putting up these charts of the average mortgage payment, which went from about $1,000 a month to $1,800 a month. And they said, look, the average payment has gone up 80%. We're going to have a crash in housing. But what happened was people who are in low interest rate mortgages, like 2.5%, 3.5%, are in houses that they're trapped in. They can't move, because if they move, they would have to get a 6.5% mortgage. So there's no supply of houses on the market. Our transactions are lower than they have been in years, and prices actually keep going up. Counterintuitively, the worst thing for the housing market would be if interest rates went down 200 basis points and all this supply would flood the market. Then you would see prices come down.
Interesting. That's an interesting take. Look forward to following that one. I haven't done enough on real estate discussions recently. I promise my audience that will change, so we have more upcoming. I'm going to keep on going in and out of kind of the dollar type discussion. Here's maybe another one. Will the middle class in the US, be wrecked, be destroyed when the dollar collapses? Now, that's a little bit of a stark statement. That's not going to happen today or tomorrow. It's probably not going to happen the next year or two. But eventually, again, broken clock is right twice a day. But just look at it. Every one of those investors is practically, with their stock portfolio, their real estate, their cash, whatever, they're like 100% denominated in US dollars. If that were to go down, dollar loses and inflation skyrockets, I mean, we may be talking about a complete and utter disaster.
Yeah, maybe. I mean, I think one thing a lot of people need to do is to diversify into international stocks.
Yes.
You know, the best, I mean, that's the best way to diversify. And if you look at Europe, you know, Europe has underperformed the US for the last 15 years, but the main reason that's happened is because Europe doesn't really have tech stocks, you know. But if you have some reversion where Europe actually outperforms the US, plus you get the currency kicker. Like, you know, I remember when I was at Lehman Brothers back in the mid 2000s, the dollar was very weak and international investing was super, super popular. Everybody had big allocations to overseas funds. It's not the case anymore. Everybody is 100% in the US. So you have to diversify. Emerging markets, Europe, developed markets globally. Like, you have to get out of the US.
Now, when it comes to the super rich and the billionaires, what I would deal with in my consulting and in the work in the family office community, it is a little different. They are, I mean, I hate to say more sophisticated, but the reality is that kind of money and the resources they have through banking, through their own single family offices, normally does provide them an opportunity for diversity, which is more boring, but creates the opportunity for hedging. Debatable, but I'm going to go with yes, it does for the most part, more risk. So they're often going to have, what did I mention before? The krona, the Singapore dollar. Some of them will have entities, family offices in Switzerland and Singapore, offshore, that are more actively active in global currency markets. So that's why I don't think that audience will be as impacted when the dollar inevitably, whatever, goes down 40 or 60%. But perhaps a discussion that we could save for a little bit of a future time. Still staying on that topic, but with a little different spin, the BRICS. We now know, especially with what's going on with Russia and China and aligning and whatever, South Africa and Brazil, and I could throw the Saudis into there as well. This again goes back to, is the dollar always going to be the almighty? Will these BRICS create a currency effectively that will be a threat? And suppose it's partially, not even fully, partially, it's not just smoke and mirrors, it's actually backed by some commodities.
No, I don't think so. You know, I don't really buy into the whole de-dollarization thesis. And I think even if it does happen, it's going to happen over a period of 50 to 100 years, not in the next couple of years. So I'm not really concerned about that. I mean, if you look at, for example, Argentina, you know, Argentina has an election coming up in the fall where, you know, one of the candidates who's leading is a proponent of dollarization, right? Like, Argentina at some point in the near future is going to adopt the dollar as its currency. They're not adopting the yuan, right? I mean, I think that's an important distinction. So, you know, the dollar is used for everything from drug dealers to like war, and it's just not going away. And if it does, it's just going to take a really, really long time.
I mean, I guess I'll make a comment that you'll probably agree with. It appears to have been true for a long, long time. The reserve currency of the world usually belongs to the country that has the heaviest hammer, that effectively has, AKA, the most powerful military. That appears to be the truth.
It's actually about naval power. It's the country that has the strongest navy that gets to have the reserve currency. It was true of the British, it was true of the Spanish, and it's true of the United States right now. If you wanted to mark on your calendar when the dollar loses its reserve currency status, it's when we go to war and lose an aircraft carrier.
Wow. That's an interesting comment. I'm going to have to, this will get one of my 1 minute clips up on YouTube. Thank you, by the way. I like that one. I know you're not as much of a fan for what I described about eventually you probably are, but in the relatively short term, under 50 years, you're probably not. But I'm still going to ask it anyway. If you were someone that could create a one world currency, it would likely be backed by some level, you could argue, of commodities. Or if that even were to happen within 20 or 30 years, what would make up that basket? Would it be the obvious choices, oil, gold? Would it be others? Do you have any feelings about that?
I would say just gold.
Okay. That would keep it simple, right?
Yeah.
Let's get back to what you did mention earlier, and I promised I would come back to. So long-term GDP growth basically has been, well, let's see, since World War II, population growth coupled with productivity growth. It really isn't that hard. Now, like we did discuss with the question that came in earlier, we'll soon have declining global populations. Productivity growth is going to be challenged. Boy, that's a bad mix for, especially, well, depending on lots of different factors, how it could play out from an economic and a stock market perspective. Actually, it sounds really damn gloomy, but hold on, there may be a savior in sight. What do you think? And I'm not the first person to say this. Effectively, advances in technology, robotics, and AI, coupled with one day, free energy will counteract the lessening of population and productivity per person. Where am I right? Where am I wrong?
No, I think you're absolutely right. I mean, just if you're talking about AI, I think that's going to be a massive, massive productivity growth. You know, I remember trading in the late 90s and early 2000s when we were putting up those big productivity numbers under Greenspan when the internet showed up. Like it's really going to be once the AI that we have with Chat GPT, Chat GPT is basically Netscape. Like it's very primitive and it's going to get more sophisticated over time. And it's gonna cause a productivity explosion. So I totally agree with you.
Okay. Gee, it would be more interesting if you didn't, but no, I think it's probably a little bit hard to argue that. I mean, getting a little bit to we didn't even get into it. We're going to talk about the deficit, but this plays a little bit into that. And again, if I want to go a little down a doomsday path, the repo markets, for those that don't know, a dictionary definition is where participants borrow cash overnight by pledging collateral, usually treasuries or state-issued mortgage-backed securities. I couple the repo markets with effectively the shadow banking sector and the derivatives market, and Buffett and others have spoken about this. I'm definitely not the only one. Gee, this is like, I mean, you were at Lehman, you're going to know more than me. This is this a house of cards?
No, absolutely not. Like one of the things, people look at is they say, oh my God, we have, 10 quadrillion notional worth of derivatives out there. So it's going to blow up, and it's absolutely not the case. Even though the notional amount of derivatives outstanding may be large, but the delta on those derivatives is actually very small. Like when everything is hedged, there's really not a lot of net exposure. So that notional number is kind of meaningless. And I don't think there's an excessive amount of derivatives or leverage in the system. I think it's totally safe.
Okay, well, you make me feel better. I mean, I guess maybe I am a little bit of Mr. Doomsday. We are in the early stages of, I guess I could have said this during any decade, but okay, I'm still going to say it. Early stages of a geopolitical turning point. As in any early stage of a regime shift, and things are changing, but that means opportunity for investors. Would you say that a relevant question to ask, and maybe this is more geared to the single family office type investors with decades to work with and billions, what will the new world order look like? And part two, how will the transition unfold?
I don't know. I am not a geopolitical expert. I really have no idea.
And if what you're saying is accurate, and in many ways I really hope it is, that it still may be multiple decades, even breaking the past trend before the dollar is no longer, quote unquote, the world reserve currency, and the world is kind of coming to an end. So that may not be something we have to worry about for a long time. But I'm going to go back a little bit to the deficit. So what is it now? About 31 trillion. And is the shadow deficit, I don't know, like adding up pension obligations, or I guess pension obligations could be cut, whether it's morally right or not, whether it's even contractually rightfully not, no idea. But is the shadow deficit arguably, and this may, you partially answered it with your opinion on repo and derivatives market, but even if not, the 31 trillion plus arguably a shadow deficit, we're not taking in enough revenue unless we hyperinflate. Like, how is that going to be addressed?
So I don't know if you remember this, but back in the late 90s, the up and down Wall Street columnist for Barron's was a guy named Alan Abelson, passed away about 10 years ago.
Sure.
And he was like the super bearish guy. And once a month, he would post this chart of total debt to GDP in the US. And at the time, it was about 190%. Now it's at 400%. But he used to post this chart and say, we have total debt to GDP of 190%. Everything's going to crash. It's unsustainable. And, here we are 20 plus years later, and it's twice as high. And everybody's saying it's going to crash. It's unsustainable. I mean, for sure, at some point, the level of debt gets too high and there is a problem. But I don't know where that is. Usually a country starts running into trouble when debt to GDP gets to about 100%. We're a little bit above 100% right now, but we have the reserve currency. Japan's at 240% debt to GDP. So like these numbers really have no meaning for trading purposes. They're big numbers, but you can't really trade off of them. So I tend not to really worry about it until, I will start to worry about it when Treasury supply starts materially affecting auctions and interest rates. When we're auctioning 60 billion, 80 billion, 100 billion of tens, and people are not showing up at auctions and rates are shooting higher, that's the time to be worried about
it. One of our live participants who knows me personally sent in a text. It's a little bit long-winded, and my God, this guy, you're more of a downer than me. His comment about that, and you could comment, how can the US sustain or hard reset its debt-driven system when at least there's 100 trillion in debt when adding in municipal, state, federal, and private debt, kind of the part two. If it cannot sustain or hard reset, how many generations of decline will be required to get sustainable, given the current debt represents the wealth of all currently alive generations? Ooh, you are negative, sir. What do you think, Jared?
I'm
just going to give up.
I don't know. Like I said, this kind of stuff is like fun to think about, but you can't really make money off of it. It's just, I don't know. Look, I'm a trader, and I'm not focused on the micro term. I'm not focused in minutes or hours or days or weeks. I'm focused on months or years. But this is like 100-year, trends that we're talking about here. And it's just outside the scope of what I do.
Okay, let's bring it back a little bit, even to investing. So Goldman Sachs this year in 2023 came out, and I got, of course, secret access to it, to the Family Office Investment Insight Report. I'll stick a little bit to the allocations for now. So maybe I want you to put your hat on. You're being hired by, and you're given seven figures, Jared. They're paying you top level to be a consultant. to help them on their allocation. Let's assume they're a long-term family focused a little more on aggressive growth, and they got $1 billion liquid. So the Goldman Sachs report was specifically to billion-dollar families. I'm going to give you some of the allocations, which are broad. We don't go micro into them because they don't give me that, unfortunately. And do you think that feels about right to you? They're claiming that billionaires are 28% of their allocation is invested in public market equities. 26%, almost the same, is effectively in private markets, or AKA private equity. Before I go into the others, that does feel about right to me. Each family's different goals, different time horizons. But again, the example of the super, super rich, that breakdown, which is pretty close to 55, 60% in public markets, and almost a similar amount to total that amount that I gave in private markets, feels about right to me. How about you?
I think that's too high.
Okay. So let's go into the rest. They're claiming 12% in cash and 10% in fixed income, and almost 10%, 9% in real estate, but they lump in infrastructure with real estate. So that's almost 10, 10, and 10. Cash, fixed income, real estate. I'm assuming you feel that that's too low.
Yeah, that's too low. Real estate, bonds, cash should be higher. And is gold mentioned in there?
I'm getting to that. Hedge funds is 6%. That's up a little bit from 2 or 3 years ago. But as you noted, although hedge funds might have done pretty well last year and the year before last, active management, we could get into concentration and leverage and all that again, but it has not done so well necessarily this year. So I felt 6% was a little high. They're 3% private credit, and your gold, they're lumping in all commodities at only 1%. That seems a lot low to me.
Yeah, that's really, really low.
So, I mean, the other answer, and I'll just be honest, speaking from the single family office community, you want honesty, here you got it. We all like research. We all like reports. I do them too. They make good social media fodder. It's a great subject to talking about. Look, I've mentioned Goldman Sachs now a couple of times, and we're talking about it. It's self-answered reports. A lot of families and SFOs don't want to tell you their secret sauce. They don't want to tell you what they're really doing. They might even want to misdirect you. I hate to tell you the truth. It's just how the world works. So it's fun to talk about, but I just don't know how real this is. You might have some families that they may be 40% in commodities, actively trading, making 200% a year. They're not going to tell you that.
Yeah, I mean, I think, when you gave me all those allocations, the takeaway I had was that the allocations to real estate and commodities are really low. And the reason I say that is, that's your inflation hedge, real estate and commodities. Real estate is a great inflation hedge. So if we are in an inflationary environment. I mean, inflation is coming down at the moment, but I don't think it's going to stay down forever. And I would say a combined allocation between real estate and commodities should be closer to 30 or 40%.
Yeah, I'm maybe not quite as much on the real estate side as you, even as a combined, but I'm probably a little more in that camp than not. By the way, someone did have a pretty funny comment, and I'm not so sure it's not true. When I asked you earlier about the energy drinks, they said energy drinks are this generation's cigarettes. There's probably truth to that.
Yeah. And after you mentioned that, I thought about it. Those energy drinks are really, really high margin. Really high margin.
Yeah, caffeine is cheap, sugar and water and artificial flavoring.
Yeah.
That's probably like 10 cents, and you sell it for what, $4, $5, $6.
Yeah.
Yeah. Yes, that's a great business. Maybe that's a business for me to get involved in as well. Related a little bit to what we spoke about earlier about being overly, US dollar denominated. I'm probably more fearful of that than you are, but even you have some concerns that people may be a little too much dollar denominated. I'm looking at some of my notes, and this is real insight without no Mr. X from billionaires. Commodities, supply chains, airports, shipping, containers, even rail and trucking. These are real things that multi-billionaire families are doing. Are there things that could get them greater returns? Probably. But again, they may be looking at a 50 to 100-year plan. Now, I will mention a couple that I would perhaps recommend. Art, global farmland, rare earth, gold, diamonds. I'll throw a little bit of Bitcoin in there. And currencies, including some that I mentioned after the dollar. Any specific feelings, Jared, about some of those that are a little more esoteric, like art and farmland?
I think art is probably a little overpriced at the moment.
Why do you feel that?
As part of my degree, I took a couple of art classes, my writing degree, and I got to learn a little bit about the economics of the art market. It's very speculative, and you could see those valuations come down a lot potentially in a recession. I don't know how much they came down in 2022, if at all, but I'm a little uncomfortable with it. Everybody knows about farmland. Everybody's heard about Bill Gates buying up farmland. People were talking about that in 2006. Yeah, for sure. But farmland is a lot more expensive than it was 20 years ago.
Oh, for sure. I'm looking at one of the questions from one of our participants. We were kind of past this, but I'll bring it up maybe just one last time. And I did bring this up with Mark Faber a couple of months ago. That went down an interesting path. We could possibly have a dual reserve currency status, arguably in the next decade. But the big point that I think he was getting to was maybe a one world currency, a dual reserve status. And basically, we are trending towards central bank digital currency. And I think the real evil part that he may be getting to with that is effectively, they'll have insight and arguably control over everything. Meaning if they feel that climate change is a major, major, major issue and you're eating too much meat, you're limited in terms of how much, 4 pounds of meat per month per family member. I mean, I may be embellishing and exaggerating that point a little bit, but, and again, I know this goes into big picture macro and disaster, and it may not be your core area of focus, but what do you think about that?
Yeah, I mean, central bank digital currencies is something that a lot of people have been talking about. Glenn Beck, right? I don't know if you listen much to Glenn Beck, but he's been talking about it for a while.
He has, you're right.
So it's a little bit of a boogeyman. This is another one of these things. I think it's going to take a long time to implement. I certainly hope it doesn't happen. I mean, the potential for abuse is just enormous. So, I'm kind of an old-fashioned guy. I like to carry cash. I carry a large amount of cash on me when I'm just kind of traveling around town. I pay for lunch in cash. I pay for dry cleaning in cash. I pay for just about everything in cash because it has that anonymity. Just because I'm going out to lunch and I have nothing to hide doesn't mean I want the government to know where I went out for lunch. So I actually don't even use credit cards that much.
Wow. Yeah, I'm probably a little bit more in your camp relative to that. I am definitely not a fan, especially if it's programmable money, which is I described. Now, initially, oh, no, don't worry, it's not programmable. It's just ease and efficiencies digitally, AKA central bank digital currency. There is no question that will transition to programmable money, which again is what I described in one really negative perspective. I don't know if there's any way around that. Could we as a country, the world wants to go that route, we basically give the middle finger to Maybe, but I don't know if we have the political fortitude and education of our populace to understand that. Again, most people are the masses. Most people are followers. Most people want their day-to-day life to be effectively ease of use. I don't know if they're true libertarians and concerned about privacy. I think we may be fighting an uphill battle on that one, but don't give up is what I'd probably say. One of my favorite investors, God, he writes so well, is Howard Marks. Here's a Marks quote. When times are untroubled, asset owners get complacent and buyers are eager. No one has an urgency to exit, making it very hard to score significant bargains. But are we at a time now, Jared, where the super rich that have dry powder, have cash ready to go, and there's real estate owners in commercial real estate that may be floundering, that may have issues relative to their interest rates, with refinancing, with over-levered, a whole bunch of things, where now actually is a time to buy, or is it too early?
That's a good question. I never really thought about it like that. Look, there's always there's always a bull market that's somewhere. There's always stuff to buy. This idea that you just presented of, wealthy people investing in commercial real estate at a discount. I mean, that's kind of interesting. Yeah, I mean, one of the picks for my newsletter is an office REIT based in New York City. So, it gets a 16% dividend, and it's done pretty well. We got it at distress levels. So yeah, I mean, I think, speaking about commercial real estate in particular, I think that we've reached kind of peak panic about it. It's all over Twitter, it's all over the news, everybody is thinking about it. And I've never seen the financial media call a crash in anything. Like they're not the ones to predict a crash. So actually, I think the resolution here is not going to be all that bad.
And another Howard Marks, a little longer, but your opinion. It's completely the opposite of what you described with Jim Grant from Grant's Interest Rate Observer. Marks, will asset ownership be as profitable in the years ahead as it was from 2009 to 21? Lending, credit, or fixed income investing should be correspondingly, unlike that era, better off. He says, sell off the big, might have been a little tongue-in-cheek, sell off the big stocks, the small stocks, the value stocks, the growth stocks, the US stocks, the foreign stocks. I disagree. Sell the private equity along with the public equity, the real estate, the hedge funds, and venture capital. Sell it all and put all the proceeds into high yield bonds paying 9%. Again, I believe said a little tongue-in-cheek, but is there a grain of truth to that?
I guess. I mean, I think about high yield, and 9% is pretty good, but I think high yield is actually a little bit overpriced here. I don't think it's necessarily cheap. But his sentiment that you want to sell off risky assets and put it in high yielding assets, getting income. I mean, this is something that people have been doing for the last year. Maybe not in high yield, but in CDs and money market funds and high yield savings accounts. Like people have been de-risking. So the question is, do you want to get 5% in a T-bill, or do you want to get 9% on high yield? I think I would rather get 5% in a T-bill.
You could definitely make that argument. And again, I probably agree with that one as well. I think you'll agree. I'm going to do about a 40-second here. On behalf of both me and Jared, I'll even say it. One, thank you all for our live listeners and those listening or watching in. This is a discussion about a lot of things economic and investing. It is strictly for entertainment purposes. It's opinion. I've been wrong a million times. Jared has been wrong once or twice. This is just for engaging and entertaining purposes. Also, it's June 23rd, 2023. You may hear this a month from now. We may all have different opinions. You may hear it 2 years from now. We're almost guaranteed. Again, Everyone's situation is different. You need to deal with your own advisors relative to your risk tolerance, your availability for cash, and your situation. It's all completely different. My audience focus is mainly on the super, super, super rich, often billionaires. They have a very different perspective investing than even a generally successful person. So again, none of this at all is investment advice. It strictly is for engaging and entertaining purposes. And when you invest, well, what could happen? You could lose money. Understand that. Okay, we're done with that. Charlie Munger, another, of course, iconic figure. He says you should form a thesis, but you should always ask yourself, what would cause you to change your mind? Take the opposite perspective of your thesis. And I would define that as one of the most common things I hear from billionaires about how they got super rich is think for yourself. So what would be your perspective on a thesis, looking for the reverse argument, not getting stuck in confirmation bias, and realizing what you learned in college 40 years ago, some of it may not apply now. You got to have new thinking and effectively think for yourself all the time.
Well, I'm a trader, so I always think about how I could be wrong. And how I could be wrong with my thesis at this moment in time is that the labor market stays hot forever. The economy stays hot forever. The Fed keeps hiking interest rates. We get Fed funds of 8, 9, 10%. Stocks go down another 20%. Tens go up to 5 or 6%. Gold keeps going down. I mean, that's the opposite of my thesis, and suppose it could happen, but I tend not to think so.
Before we head to a close and hearing a little bit more about your books in about 10 more minutes, why don't we go round robin on a fair number of questions quickly? Of course, we'll start with one that's a little bit of a political football, actually probably two of them that will be back to back. Strictly from an economics, macro, and investing perspective, including obviously in commodities, what I mentioned before about BRICS, your opinion about how that could be impacted by how things are still progressing with Russia and Ukraine war.
Actually, I was talking about this with somebody yesterday about sort of black swan events that nobody's thinking about. Like one of them potentially is that the Ukraine war comes to an end. Like how would you invest today if you knew that there was going to be peace in Ukraine? Kind of an interesting thing to think about, right?
You're right. I didn't think about it from that perspective. That is an interesting perspective.
Yeah.
The US has more business interest with China than it does with Taiwan. So the IP of semiconductors really is here in the US. It's built, quote unquote, in Taiwan. We're looking to change that. I mean, will the US really militarily react if maybe the inevitable China invades Taiwan happens? Again, I know we're going off into political issues and some that are a little sensitive, but any opinion about that?
Yeah, so China is kind of a special case. I have an interesting tidbit. The US has never been at war with a country with a McDonald's.
I don't even know. Does China have a McDonald's? I'm assuming
China has McDonald's. Okay. And so this kind of gets back to that Bastiat quote, like, when goods don't cross borders, armies will, right? So we have an incredible amount of trade with China. And one of the things that concerns me is pulling back this trade with China and, ultimately them becoming economically isolated. Like that is the prelude to war. It's kind of hard to go to war with a country that you're a big trading partner with. It's very difficult to do that. So, Now, do I think the US would react militarily if China invaded Taiwan? Absolutely, I think we would.
Okay. Uh, we're getting a little closer and a little closer to you know what here in the US. That would be elections. Any specific, I mean, it still is well over a year out. You can make the argument that Biden is really looking to tighten things up, that being careful that the stock market doesn't crash, so maybe has some input on interest rates and all that. Obviously, they want the employment numbers, maybe most of all, to look great. But how do you think some of this could play out? Do you have an opinion? Will Biden even be the candidate? And on the other side, assuming he's able to and not in jail, would it be Trump? Would it be DeSantis? Give us a political opinion, Jared. Why don't I put you on the spot?
Yeah. Elections are unpredictable, right? Like,
yes, nothing else.
And we still have more than a year to go. There's, I would say, a 50% chance that neither Trump nor DeSantis is the Republican nominee, and that Biden is not the Democratic nominee. It could be somebody totally different from the field. So it's way too early to be making predictions for that. One person I like a lot is Tim Scott from South Carolina. Living in South Carolina, I'm pretty familiar with his politics. He has a reputation as the nicest guy in Washington. He's a pretty reasonable Republican. He's not extreme. He's probably running for VP at this point, but he's a terrific candidate.
Interesting. I like that insight. I'm going to have to learn more. So awesome. Does the mental state of Gen Y and Gen Z affect the future of the economy? That's an out of left field question, Jared. I got to give you one or two.
Yes, but I don't know how. I've thought about that before, but I just don't know how.
Any somewhat related, any opinion why these generations or those that I mentioned kind of hate the top 1% so much? Resentful. Are they conditioned? And now I'm going to go with my crazy theories. Are they conditioned by nefarious forces in, I don't know, society and education to be quote unquote so resentful against those that honestly often come from pretty humble backgrounds and build great companies?
When I was in junior high, I took a social studies class and we talked about Russia. And the teacher I had at the time, he wasn't anybody special, but Russia was communist at the time. This was before the Berlin Wall fell. And he said that central planning doesn't work because you cannot have a central authority direct the activities of millions of people. It just doesn't work. And I think about that as an adult, when I was in junior high back in 1987 or 88, and that was a pretty right-wing thing to say, and I grew up in Connecticut, in a part of the state that was pretty liberal,
Oh, where did you grow up in Connecticut?
Norwich.
Oh, okay. That's more the northern part of the state. I'm in the southern part.
Yeah. So I think education has changed a lot since then. I don't have any kids, so I don't really have any insight as to what's being taught at schools. But I mean, as to your point about, class warfare being taught in elementary schools or high schools, I mean, I think it's entirely possible.
In what scenario, probably a pretty bad one, in what scenario does gold go to 4,000 to 5,000 an ounce?
I don't know about 4,000 to 5,000. I think it can get to 2,500 if the Fed even cuts rates once. I think if the Fed pauses and cuts, I think that's enough to get gold to 2,500. I don't know about 5,000.
Are rare earths the next bubble?
No opinion.
Are food shortages on the horizon?
Yes, probably.
In what scenario? This is a question coming in. Boy, we got some pretty interesting people in the chat. In what scenario does the 10-year go to 20%?
It could happen 3 to 5 years from now. 3 to 5 years from now, if we have a resurgence of inflation, if we have another inflationary impulse, if we do stimulus spending for whatever reason, I don't know. Let me put it this way. I don't know about 20%, but I think 10% is a possibility.
And for those that aren't familiar, one, I highly recommend that they follow you on Twitter, that they learn about your daily dirt nap. If you could talk a little bit about your newsletter and the value from both a young person looking to be more active, learning insights to investing, to even a family office. If you could talk a little bit about that, please.
Yeah, I mean, the one thing that I do different from everybody else is that I focus on sentiment, almost to the exclusion of everything else. I focus on sentiment. I focus on how people feel about stocks or bonds or asset classes. And, what I found in my career, and I've had a 24-year career, is that fundamental analysis is really not useful for trading. Technical analysis is sometimes useful, but sentiment analysis always works. And I use it to identify big turning points in the major asset classes, and I do it pretty successfully. Also, the newsletter is very well written and it's funny. It's really entertaining. Comes out every day, 225 days a year. So check it out.
Nice. And a question I'm going to start to ask the many economists, macro thinkers, investors that I have on. So you're going to be the first. And I know there's a whole bunch of them that we both know in Puerto Rico. Who are, even just one person, someone broadly in your field in that realm that you enjoy, maybe even subscribe or know them personally, that others should be familiar with?
Gosh.
There's just too many, I know.
Yeah, I don't know if I have an answer for you.
Okay. And tell us a little bit about your book, the latest. You have multiple. No Worries, How to Live a Stress-Free Financial Life. We hinted a little bit about that when we began the interview, but maybe put a wrap on it now so we can learn more.
All right. So that book is coming out in January. It's a personal finance book, and it is going to revolutionize the way people think about their money, from the framework of minimizing financial stress, which I think applies to people of all income levels. It applies to poor people, it applies to rich people, it applies to people in the middle. So that book is coming out in January. My most recent book came out in April. It's called Those Bastards, and it's a collection of essays just about life. And it's super entertaining. It's poignant. It's funny. It's sad. It's a very cool book. It's got great reviews on Amazon. It's actually my best reviewed book. It's got 4.7 stars. So yeah, it's done pretty well.
Wow. Yeah. My book on the effective family office, you got more than me. I think I'm 4.4. Damn it. I don't have that many reviews. I had one person give me like whatever, a 3.5. It's like, shit, that held me back. So let's get some 5-star reviews up there for the family office types in my book. Since I think this is a question that you would enjoy, and it's good to mix things up with the audience a little bit as well. We all have a personal life too. What music are you listening to lately?
Oh, so this is my iPod. I still listen to music on an iPod. And I found a great track today. It's off the Injuna Deep 14 compilation. It's a remix of an Above and Beyond track. It's remixed by Prof. And this is like my new favorite track. The track is called Surge, and it's the Prof and Igor Garanin extended mix of Above and Beyond. So great track.
Interesting. And what instrument again do you play?
So I played piano. I was a church organist in high school. I played drums. I played clarinet, and I'm just learning the guitar.
Nice, nice. Given that you have a musical, both instinct, passion, and putting the work in, and I'm actually asking from my own perspective, I think the piano is deemed to be among the hardest. How are you finding the transition to the guitar?
Guitar is harder than the piano.
Wow. I'm a lefty. Not that that matters. I'm looking at my acoustic guitar now. I went through a phase where I was really into it for 3 or 4 months, and then I got out of it. I still remember the chords actually pretty well and not bad, even the bar chords, but the scales and stuff like that, I'm like starting from ground zero.
Yeah.
But
Yeah.
it's a good passion to have. And I'm so great that you like music. I know a lot in our audience do. Well, Jared, it's been great to have you on. For those that would like to follow you on Twitter and look into or subscribe to your newsletter, how could they do that?
Twitter, I'm at Daily Dirt Nap. And if you want to subscribe, it's www.dailydirtnap.com. Just hit the subscribe button.
Excellent. And as I wrap up, it's been great to have Jared on. We had him on once before, which is not enough. We'll see how some of this plays out later into this year, definitely into next year. So we look forward to having him on. Everyone, I'm Angelo Robles, the host of the Angelo Robles podcast, the founder at Family Office TV and SFO, that stands for Single Family Office Continuity, and founder, but no longer active shareholder or involved in the great Family Office Association. You can follow me even on my personal site, which is simply angelorobles.com. I'm extremely active on social media. I would mainly look at LinkedIn and YouTube. Those are going to be activities and various platforms that I have, both at Family Office on YouTube. And by the time you see this in a couple of weeks, I'll also be at Family Office TV on YouTube and eventually our own site. You could reach out to me. Basically, I help billionaires create or redesign their single family office. I travel the world doing that. It's a lot of fun. I'm so fortunate. And I get a chance to talk to amazing people, investors, economists like today, macro thinkers, all sorts of people. So it's one of the things I love to do. If you don't, please subscribe to my channels on YouTube, and very much look forward to interacting with all of you. On that note, thank you to our live audience, those that watch and listen in the future. And Jared, great to see you again and have you on. Look forward to later in the year.